The Second World War, the deadliest conflict in history, has come to an end. With it, the United States emerges as the most dominant global power. The dollar becomes the world's reserve currency, solidifying America's influence. At the same time, one American institution rises to the top of global finance: Bank of America, now the largest private bank in the world. Bank of America, once the nation's largest by assets and market value, now serves over 68 million customers across the US and globally. At the heart of this banking empire stands an unexpected financial giant, Italian immigrant Amadeo Giannini. Giannini's childhood was far from ordinary. His father, Luigi, arrived in California during the gold rush and quickly established a successful real estate business. The family prospered by purchasing properties and hotels, leasing them to fellow Italian immigrants. Luigi was a driven entrepreneur who first found wealth through fishing, farming, and viniculture. He invested his entire savings into a house, renovated it, and transformed it into the Swiss Hotel, catering to Italian laborers. After 2 years as its owner, Luigi sold the hotel and used the profits to buy 40 acres of land in Alviso. Giannini's serene childhood came to an abrupt end when his father was tragically murdered. At just 7 years old, Giannini lost his father to a fatal shooting during a labor dispute. This devastating event forced Amadeo to grow up quickly and take on more responsibilities at home. His mother, Virginia, a young widow with 3 children, took over managing the farm. During this time, Giannini learned the importance of hard work. He followed a strict routine, waking up early to help his mother sell produce. This experience gave him valuable practical skills and insight into running a business. Giannini's mother, Virginia, eventually marries another Italian immigrant, Lorenzo Scatina. The pair met while she was out selling produce, and their friendship quickly blossomed. Lorenzo was a kind and easygoing man, always wearing a warm smile. Her children grew fond of him and respected him, affectionately calling him Pop or Boss. Lorenzo steps in to run the family farm, while Giannini takes on the role of bookkeeper, where his business acumen quickly becomes evident. He was a natural leader. By age 14, he was already managing the logistics of the family's grocery operations, such as sourcing oranges from Southern California and delivering them to San Francisco. At 21, Giannini assumes full control of the business, driving it to record profits. His approach was unique. He prioritized trust, goodwill, and building strong relationships that would benefit the family's enterprise. Tireless and focused, he worked over 18 hours a day, traveling by horse, buggy, or riverboat, often skipping meals to save time. In just a decade, he turns the family farming operation into a thriving grocery store in San Francisco, earning hundreds of thousands of dollars annually. However, at the peak of his achievements, Giannini takes an unexpected turn. At 31, he steps away from the grocery industry, eager to explore new business opportunities. The early 20th century sees significant industrial growth in the Bay Area, with shipyards, manufacturing facilities, and various other industries sprouting up. This influx of population and commerce in San Francisco and its suburbs drives property values higher. Giannini understands that real estate and banking are central to this economic expansion. To enter these sectors, he requires both capital and opportunity. At this time, his wife hails from a wealthy family, and upon the death of her father, he bequeaths his entire inheritance to Giannini instead of his own sons, reflecting the deep respect he had for him. The inheritance includes real estate properties and shares in a local bank. However, Giannini soon discovers that the bank is corrupt, much like others in the industry. To effect real change, he decides to establish his own bank. Being the son of diligent Italian farmers, he is driven by anger over how banks in North Beach overlooked the needs of San Francisco's Italian community, including his own family. Most of his clients are immigrants with limited English skills. By providing loans to the working class, the Bank of Italy quickly becomes successful. By 1905, just 2 years after its inception, the bank gathers $1 million in capital, indicating a promising future. The 1906 earthquake transformed our understanding of seismic science. On the morning of April 18, 1906, the quake jolted everyone awake. Its epicenter was located on the San Andreas Fault, just off the coast of San Francisco, and it ruptured north and south along the fault line. At that time, much of the city was built with wooden frames, although there were some steel structures. The earthquake caused significant damage throughout the city, but most destruction resulted from the subsequent fires that erupted after the quake. The 1906 San Francisco earthquake was one of the most devastating in modern history, causing widespread destruction and triggering an uncontrollable fire that engulfed much of the city. Before the fire could reach his bank vault, Giannini and his stepfather loaded the bank's assets, cash, gold, and silver, onto wagons disguised as crates of fruits and vegetables. They undertook a grueling overnight journey to Giannini's home in San Mateo. His quick thinking proved invaluable. While other banks were crippled, Giannini set up a temporary banking operation on Washington Street with a makeshift desk, offering immediate financial aid to those impacted by the disaster. Giannini and his bank made a bold move. While most banks hesitated to lend, Giannini offered unsecured loans to people based purely on personal trust. He transformed a disaster into an opportunity. Following the earthquake, the Bank of Italy became the region's most trusted bank, with deposits flooding in. During the panic of 1907, Giannini's quick thinking and decisive actions once again ensured the bank's stability and maintained customer confidence. Despite initial opposition, he expanded into Los Angeles, offering accessible banking to the city's growing population. Giannini's vision soon reached beyond California, establishing branches in cities like Chicago to provide reliable financial services to diverse communities. To build a true banking empire, Giannini knows he must conquer one crucial city, New York. However, there's a major obstacle. New York is dominated by a financial giant, J.P. Morgan Jr., who won't easily allow an outsider into his domain. After his success with the Bank of Italy, Giannini recognizes that the future of banking lies in branch banking. He envisions his bank extending from coast to coast and eventually worldwide. To achieve this, he needs a foothold in the prestigious city of New York. Following a record year of profits, Giannini uses the surplus to acquire Bank of America at 44 Wall Street, then a struggling mid-sized bank. He merges Bank of Italy with Bowery and East River National Bank, along with the Commercial Exchange Bank, creating the Bank of America National Association, making it New York's third largest bank. Giannini's swift entry into New York is seen as a direct challenge to the reigning Wall Street power, Jack Morgan. In the 1920s, Jack Morgan is the most influential banker on Wall Street. His father, the famously ruthless J. Pierpont Morgan, helped create the first billion-dollar company, U.S. Steel. Pierpont Morgan was a towering figure, the founder of J.P. Morgan, with a global network of connections. After his father's death, Jack inherits an immense fortune. He has wealth, power, and enemies. He once survived an assassination attempt by wrestling the attacker to the ground. As Giannini's Bank of Italy rises, Jack Morgan decides it's time to assert his dominance. After Giannini establishes himself in New York, Morgan initiates a smear campaign aimed at tanking Giannini's bank stocks. During this time, Giannini, suffering from polyneuritis, is in Europe for treatment, and Morgan seizes the moment, rallying other bankers and traders to launch an assault on Giannini's stock value. In just weeks, the shares nosedive. Giannini is certain that Morgan is behind the attack on his banks, but he refuses to back down. He establishes Transamerica Corporation, a strategic move to consolidate his banking empire and facilitate further growth. With bold decisions like this, Giannini signals his commitment to making a mark in New York, and eventually, the market calms. Morgan's attempt to derail Giannini's progress fails as Giannini cements his banking foothold in New York. However, neither man anticipates the looming crisis that will test them both. Black Tuesday devastates the financial sector. Stock values collapse, triggering mass bank withdrawals and countless failures. Many banks heavily invested in the stock market face insolvency, and public trust in financial institutions crumbles, sparking a wave of bank runs. Giannini's Transamerica stock takes a sharp dive, leading to major financial losses for its shareholders. In an effort to defend the stock's value, Giannini makes a bold move by purchasing all 230,000 shares of Transamerica, dumped on the San Francisco Stock Exchange. However, this rushed and risky decision fails to achieve its goal. As stock market volatility intensifies, internal conflicts erupt within the Transamerica board. While Giannini fights to keep control, his greatest rival is ready to pounce. Sensing vulnerability, Jack Morgan orchestrates another stock raid on Transamerica, causing wild fluctuations in its price. Like his father, Morgan despises competition and holds immense sway on Wall Street. If he labeled Transamerica as a poor investment, the market would sell off, allowing him to buy shares cheaply and install his allies on the board. The CEO of Transamerica at the time, Elisha Walker, a former Morgan associate, becomes part of a larger conspiracy. Behind closed doors, Transamerica's executives and board members secretly plot to remove Giannini as chairman. With no other choice, Giannini resigns from the very company he built from the ground up. Along with Giannini's resignation, most of the California directors are replaced by New York appointees, fulfilling Jack Morgan's long-held ambition. Though Morgan seemingly outmaneuvers Giannini, he underestimates his resolve. Determined to seek revenge, Giannini refuses to back down. Transamerica, a banking holding company Giannini founded to challenge New York's financial giants, now appears lost after orchestrated attacks by Morgan force his resignation in September 1931. It is a major blow for the banking visionary. Despite stepping down, Giannini retains a substantial stake in Transamerica. Recognizing an opportunity to turn his defeat into victory, he forms a coalition of shareholders and rallies them against the current board and management. As a respected West Coast banker, Giannini enjoys a better reputation than the ruthless Wall Street figures, and he knows most shareholders will back him because of his character. With growing support, Giannini initiates a proxy battle at the shareholder meeting. If successful, he plans to reshape the company and revolutionize the banking industry on the East Coast. Yesterday, sweeping changes were announced within the Bank America Blair Corporation, a Transamerica subsidiary, including the resignation of 9 officers. Ultimately, the majority of shareholders side with Giannini. When Giannini takes over as chairman of Transamerica and Bank of America, the old board, filled with Morgan loyalists, is swiftly dismissed. Few moments in history are as monumental as this. Here's a man who started from nothing on the West Coast, only to come to New York and dethrone the King of Wall Street without being a ruthless robber baron. When Giannini arrived in Los Angeles at Union Station, he was hailed as a hero. Thousands of employees and stockholders greeted him with cheers and gratitude. Giannini's success in building Bank of America into a financial powerhouse came from his integrity and tireless work ethic. In 1932, A.P. Giannini returned to his office at 1 Powell Street, rejuvenating the Bank of America during a time of financial distress. His Back to Good Times initiative successfully restored public trust, resulting in a $50 million increase in deposits. Despite facing regulatory hurdles and powerful opponents, Giannini's leadership secured the bank's survival and expansion. By the late 1930s, Bank of America emerged as one of the nation's wealthiest banks. However, as the world descended into conflict, the bank chose to put aside its rivalries and collaborate with other bankers, including Jack Morgan. Together, they financed the transformation of America into the most formidable war machine in history. By 1945, Bank of America had become the largest commercial bank globally. Giannini epitomized the ideal banker. His success hinged on his capacity to instill confidence. Witnessing the realization of his vision, Giannini eventually retired and allocated half of his fortune to education and research. In the spring of 1949, Amadeo Giannini passed away peacefully in his sleep due to heart failure. Amadeo Peter Giannini, the son of immigrants who built a financial empire, including the world's largest bank, died at his home, Seven Oaks in San Mateo, at the age of 79. Before we continue today's video, let's take a moment to talk about our sponsor, Recession Profit Secrets. If you're concerned about the state of the economy and how to protect your financial future, this might be exactly what you need. Created by Richard Pierce, a former CIA data analyst, Recession Profit Secrets reveals how to use economic cycles, called K-waves, to actually build wealth during recessions. Richard's system is based on patterns he uncovered during his time analyzing classified data, and now he's sharing it with you. With this simple step-by-step guide, you'll learn how to spot these cycles and make smart financial moves when others are panicking. And right now, if you act fast, you'll also get some valuable bonuses like the Ultimate Recession Investment Guide and Top 10 Recession-Proof Stocks. If you're interested, there's a link below this video. Click it to access Recession Profit Secrets and start preparing for the future today. Thanks again to Recession Profit Secrets for sponsoring this video. Now let's get back to the video. Giannini's impact resonates throughout all aspects of American life, particularly in California. His funeral was held on June 6, 1949 at St. Mary's Cathedral in San Francisco. Over 2,500 individuals filled the cathedral, while thousands more gathered outside to witness the procession. He was laid to rest in a private ceremony not far from his residence at Holy Cross Cemetery in Colma. Adhering to AP's wishes, all Bank of America branches globally remained open throughout the day, catering to the public. Giannini genuinely established a bank for the average person and upheld that principle until the end. Even after building the world's largest private bank, boasting over $6 billion in assets and 517 branches, Giannini led a modest lifestyle and did not amass considerable personal wealth. At the time of his passing, AP Giannini's estate was valued at just $489,278. During the late 1950s and early 1960s, the U.S. economy witnesses significant growth and stability. Following World War II, prosperity continues unabated. High consumer demand coincides with low unemployment rates. The early 1960s, indeed the entire decade, marks an extraordinary economic boom, surpassing both the 1950s and the 1970s. Particularly for students entering the job market in the early 1960s, job security was never a concern. There was a widespread shortage of skilled and intellectual labor. Universities thrived. California's economy flourished, emerging as a powerhouse supported by various sectors and holding the title of the largest bank in the country. Following Giannini's passing, Bank of America requires fresh leadership to harness this economic surge. The new CEO, S. Clark Baze, understands the imperative to prioritize company growth. Although shy, Baze is well-versed in banking from A to Z. He managed the bank through delegation, making excellent appointments and earning universal respect, reigniting growth. In 1959, Bank of America introduces the Bank of America card, providing credit cards to 2 million families in California. This innovation lays the groundwork for modern credit, transforming consumer spending and financial services. This was a groundbreaking development at the time. Bank of America enables everyday customers to easily access credit, facilitating their ability to purchase goods and services. It allowed cash-free transactions and stimulated consumer spending, thereby promoting economic growth. California's economy thrives with Bank of America's deposits surging to over $12 billion in assets by 1961. The bank's strategic investments in emerging sectors like Silicon Valley's tech industry and Napa Valley's boutique wineries laid the foundation for future prosperity. Success, whether for a corporation or an individual, often hinges on timing. The bank flourished by seizing opportunities during an era of economic expansion, especially in California. But prosperity, as history shows, is never permanent, and the economic cycle is beginning to turn. As the 1970s approach, America is plunged into turmoil. Fire, believed by authorities to be an act of arson, severely damaged a Bank of America branch near the University of California. This incident is one of many part of a larger wave of anti-establishment unrest, intensified by the Vietnam War and economic disillusionment. With Tom Clausen at the helm, Bank of America faces tremendous pressure. The bank, by this time, has grown into a massive bureaucracy, a fate common to organizations of its scale. But as complacency sets in, competitors are quick to spot opportunities to outpace it. Rivals develop innovations that could potentially overhaul Bank of America's entire business model. Perhaps the most formidable challenge comes from a much older rival, Citibank. By the early 1970s, Citibank stands as one of America's oldest financial institutions. Once the nation's largest bank, it narrowly avoided bankruptcy multiple times in recent decades, surviving through government bailouts. Now stable, Citibank is poised for resurgence. But to regain its former stature, it will need a visionary leader. Walter Wriston grew up in an influential family. From an early age, he demonstrated a fearless approach to risk, buoyed by the safety net of his family and social connections. Like many visionary entrepreneurs, he wasn't afraid of failure. After becoming Citibank's president in the late 1960s, Wriston understood that in order to propel the bank forward, he needed to seek out the next big innovation. While Chemical Bank introduced the first ATM in the US in 1969, Wriston quickly recognized its potential. The launch of automatic teller machines proved to be a monumental success. Over the following year, hundreds of electronic tellers were installed in the vestibules of most of Citibank's 270 urban branches, establishing the largest electronic funds transfer system in the country. Bank of America, initially slow to adopt ATMs, eventually followed suit, recognizing the competitive disadvantage of being left behind. However, while ATMs cut operating costs and improved customer experience, for Bank of America, the move came too late. Citibank had already surged ahead, overtaking Bank of America as the leading commercial bank in the United States. Bank of America is facing significant challenges, but Tom Clausen has one last strategy to implement. In his final year, Clausen used legal but bold accounting tactics, like revaluing long-held assets at market rates, to show stronger earnings for 1980. This gave him the chance to highlight the bank's success, allowing for a graceful exit while passing hidden issues to his successor. Following Clausen's retirement, Sam Armacost was chosen as the new president. Armacost, raised in a well-known family, his father was president of the University of Redlands, graduated from Stanford, leveraging his family's connections to rise rapidly through the ranks at Bank of America. He knows Clausen left him with problems. To drive growth, the bank needs transformation, and rather than building from scratch, acquiring an already successful company is the way forward. For B of A, acquiring Schwab would be its most innovative move since introducing computerized check processing in the 1950s. Influenced by Walter Wriston at Citibank, Armacost understands the value of technology. Under his leadership, Bank of America's modernization efforts boost operating profits by 7.5%, proving the bank's resilience during tough times. A crisis is looming, threatening to undo all his achievements. A federal grand jury in New York is investigating the collapse of a mortgage securities scheme that has cost Bank of America $37 million, according to a Delaware state regulator. Armacost, a mortgage securities company, marketed high-yield, short-term mortgage-backed securities to savings and loans, with Bank of America as the escrow agent and trustee. The plan promised risk-free returns secured by supposed insurance and precise escrow instructions, but was based on fraudulent appraisals and non-existent properties, similar to the 2008 crash. Initially, Bank of America's losses were estimated at $8 million, but as the fraud unraveled, the total loss soared to $95 million. Even more damaging than the financial loss was the blow to the bank's reputation and Armacost's leadership. NMC became Bank of America's Pearl Harbor, a surprise attack that shattered the illusion of its invincibility. This crisis was the start of a steady assault on the bank's balance sheet, morale, and stock price, leaving the institution weakened and Sam Armacost's career in tatters. In the early 1980s, Bank of America faced a series of interconnected crises: the Third World Debt Crisis, the collapse of Penn Square Bank, economic pressures from rising interest rates, and internal mismanagement. These problems together eroded the bank's financial stability and tarnished its reputation. As the bank spiraled into deeper trouble, one man saw a chance for a hostile takeover to reshape Bank of America in his vision. His name, Sandy Weill. Sandy Weill is a ruthless corporate raider. Raised in a working-class family in Brooklyn, New York, Weill graduated from Cornell with a degree in government, yet opted for Wall Street over politics. His first major fortune came when he sold his brokerage firm to American Express for $930 million. Weill's expertise lay in acquiring companies, aggressively cutting costs, and streamlining operations to create larger, more profitable enterprises. It didn't always succeed, but when it did, he gained significant wealth. However, after losing a power struggle at American Express, Weill had to exit. Unfazed, he sought new opportunities and soon saw potential in Bank of America. By 1985, Bank of America was facing a financial crisis, with its stock in freefall. First Interstate, a strong competitor during the 1980s, saw a chance for a hostile takeover as the bank teetered. A wounded giant attracts predators, and it wasn't long before Weill, known for his bold takeovers, entered the scene. Weill secured billions from Shearson Lehman, an investment bank, and proposed a merger where he would become CEO, vowing to transform Bank of America into a superpower. When news leaked that Weill was eyeing the bank, its stock soared, suggesting that investors believed Weill and his right-hand man, Jamie Dimon, would steer the bank better. Weill's leadership style, deeply rooted in a family-oriented corporate culture, also aligned well with Bank of America's legacy. Weill's focus on a corporate family wasn't just a management approach, it reflected a deep psychological need for reassurance and loyalty that only family could provide. He brought his relatives into the fold, but for Sam Armacost, Bank of America's CEO, Weill's looming takeover threat was just one problem. After years of poor performance, the Bank of America's board staged a coup, ousting him in favor of A.W. Clausen, a former president of the bank and a former World Bank president. Clausen knew that if Bank of America were to remain independent, he had to fend off takeover bids from both First Interstate and Weill. Clausen's only viable defense was a poison pill strategy, issuing new shares to dilute the ownership stakes of potential acquirers, making the takeover costlier and less appealing. To further secure the bank, Clausen decided to sell off major assets, including Charles Schwab. Bank of America publicly denied merger negotiations with First Interstate or any other institution, following a New York Times report that First Interstate had made a friendly merger proposal. The mid to late 1980s marked a period of significant transformation for the U.S. economy and the banking sector, driven by President Ronald Reagan's policies. This era, known as Reaganomics, was characterized by strong economic growth, deregulation, and free market principles, shaping the financial landscape. In the late 1980s, under A.W. Clausen's leadership, Bank of America achieves a remarkable turnaround. By 1988, the bank posts net earnings of $726 million, its third highest ever, and its stock price skyrockets from $6 to over $19, making it the world's best-performing bank stock that year. As the 1990s approach, the banking industry faces yet another shift, but this time Bank of America is prepared to seize new opportunities. The 1990s usher in a period of euphoria for the banking sector. After his failed attempt to acquire Bank of America, Sandy Weill, alongside Jamie Dimon, makes a successful deal with Citicorp, forming the largest financial institution in the US. Meanwhile, Hugh McCall Jr., CEO of Bank of America, is determined not to be outdone by Weill. Convinced that bigger is better, several American banks announced $90 billion worth of mergers, positioning themselves to compete more effectively in an industry where size increasingly matters. As banks like Citigroup and Bank of America expand rapidly, the distinction between commercial and investment banking becomes blurred. However, this aggressive expansion leads to unforeseen consequences. In what would become a watershed moment in financial history, a manic Monday sees the Dow drop over 500 points following the collapse of Lehman Brothers. The market panic reverberates throughout the banking sector, and despite its size and strength, Bank of America is not immune. The acquisition of Countrywide Financial, once considered strategic, now weighs heavily on the bank, burdening it with toxic mortgage assets. While Bank of America faced considerable challenges during the 2008 financial crisis, it was not in as precarious a position as some of its competitors. Unlike Citibank, which required multiple bailouts to survive, Bank of America managed to endure the storm. In hindsight, it may have been fortunate that Sandy Weill didn't succeed in taking over the bank in the 1980s. To stabilize the financial sector, Bank of America was compelled to acquire Merrill Lynch, saving it from the fate of Lehman Brothers. However, with the help of a $45 billion government bailout and strategic management decisions, Bank of America survived, emerging bruised but intact. Still, the troubles didn't end there. Internal disputes and leadership conflicts culminated in the resignation of CEO Ken Lewis by 2011. After first losing his chairmanship, Lewis stepped down as CEO in December. His successor, Brian Moynihan, came from a large Roman Catholic family in Marietta, Ohio, the sixth of 8 children, growing up in a middle-class household. Much like the bank's founder, Amadeo Giannini, Moynihan was known for his humility and grounded leadership style. He understood that banking was fundamentally about maintaining confidence. To bolster the bank's financial standing and reputation, Moynihan sought out an individual who could inspire unparalleled confidence in investors: Warren Buffett. Investor Warren Buffett gave a major vote of confidence to the country's largest bank, Bank of America, by investing $5 billion in exchange for a 6% dividend in stock. Bank of America had encountered trouble with mortgage investments, but the move immediately benefited Buffett, who made $350 million on paper when stock prices surged. Following Buffett's endorsement and under the leadership of Brian Moynihan, Bank of America embarked on a significant recovery. The bank concentrated on stabilizing its balance sheet, reducing exposure to risky assets, and streamlining operations. By 2024, Bank of America remains a leading financial institution, focusing on digital transformation and sustainability while posting strong financial results despite economic uncertainties. It reports robust earnings and increases its quarterly dividend, signaling confidence in its future. However, as the bank grows, it continues to wrestle with its own bureaucracy. In 2024, it faces persistent consumer complaints about fraudulent transactions, unauthorized accounts, misleading promotions, withheld rewards, high fees, and poor customer service. Issues such as slow response times, account handling delays, and regulatory non-compliance lead to multiple fines and penalties. Being a large bank makes it difficult to fail, as government support often steps in. Yet for long-term success without the threat of being absorbed by competitors, one key element remains essential: doing right by the customers. In the end, it all comes down to building and maintaining a brand of trust.